Yeah, hello once again, fellows. I want to welcome you out to the channel once again. So, if you're looking to get valuable information on investment, finance, as well as personal growth, this is the channel that you should look into. So, without much ado, we're going to be diving into today's topic, which is one of the core of investment. It's the very heartbeat of all of the investment products. So we're going to be talking about stocks today, the stock market, and information that you need to know before delving or venturing into the stock market. So if that sounds good to you, please kindly stay tuned. So to own a stock, you have to know that you are not just buying a name or ticker symbol. You are buying a real company. Stocks are a real company. They are not just one investment coined up from somewhere. They are actual companies. Real investors should know that they are buying a slice of a real company. So you should know the business behind the stock you want to buy. You have to do a full research and make a study of the company and not just buy based on hype or hearsay. If I'm putting my hard-earned money into any business or into any investment, it is my right to do my due diligence. So I want to know the fundamentals of that company, what the company is about, what drives the process of the company, so that as I'm investing with confidence. I'm not investing with just mere speculation. I'm not investing as though I'm gambling. I'm investing no matter the situation at the initial time. I know that that company will get its footing and it will start to make progress over time. So that's investment 101. You should know at the back of your mind that this investment product or this company that you are trying to own a stake of is equal to the tax to grow the value of your wealth. So there are common mistakes to avoid in stock buying, and we are going to enumerate them one after the other. So most people choose the ticker symbol and not the company's value. So you just feel like, oh, here and there people are saying this ticker symbol, they've not done their due diligence, they've not known the operation of the company, they've not known the sector that the company bases on. So they just go with the hype and pick a particular stock and put their hard money. That's a recipe for failure if you are a long-term investor. If it's an investment in the right sense of leaving your fund in that company for a longer time. The next common mistake to avoid in stock buying are when people follow the hype and not the fundamentals of the company. If you are buying a stock based on sheer hope of the value of the company increasing, that's gambling, my brother. That is not investing, because you don't know the structure of the company, you don't know the financial capacity of the company. So you ought to know the financials of the company before you invest your hard-earned money in that company. So another very popular mistake that people do while investing is that most investors don't think like owners of the company. They just see themselves putting a little of their money in the company and just relaxing. No, if you are investing in a company, you are putting your hard-earned money in the company, you should know very important information like the leadership of the company. You should know the leadership. You should know the leadership structure. Number two, you should know the moat of that company. That is the competitive advantage of the company that gives it edge and protects it in its industry or sector. So a lot of companies have competitive advantage over several companies in the same industry. Like they have their core activities, they have their core recipe, more or less like their secrets during their operational process that other companies might not know or that they might not be exposed to. So this gives it a competitive advantage over other companies in its sector. So we also have the customer loyalty. You should know how loyal customers are to the company. You should know that through thick or thin, the customers are loyal to that company because of the products that it provides to their consumer. You should know the quality of products and services that they offer. You should know that that product that they offer, they can hardly be a resemblance, they can hardly be a substitute, they can hardly be an imitation in that product and service line. So you should know the profit margin of that company. Are they profiting at a particular point in time? Are they bringing in more cash? Are they scaling as a company? Are they growing? Are they innovating? So those are one of the few things that you should know before investing in a company. So we divide what you should know about a company before investing in them into two aspects: the qualitative analysis and the quantitative analysis. As I said earlier, the qualitative analysis are just things around the company, the vision of the company. You should know that, who are the leaders and what is their structure of leadership. Where have the leaders managed before coming into that particular company, so that you know their prospects. What does the company sell? What sort of product do they sell? Where is their market niche? To whom do they sell to? Where is their customer base located at? Is it in a particular region? Is it in a particular state? Is it in a particular country? Is it a worldwide, distribution company? So you should get this information. Is there a demand for the product? You should know if there's a demand for the product. Is the product in high demand? Are people looking to get this product, from near and far? How do they make money? How do they make money ultimately? Is it just from the sales of their product or services? Do they have other strategies that they employ to make profits in the company? Do they have investments? Do they have means that they hedge on to make sure that their profit is secure? So you have to get all this information. You have to know them. So that will ultimately determine how profitable or the value of your share would be in the long run, in the long haul. So also, are they innovating on their operations? Are they imbibing AI, artificial intelligence, into their operations to make sure that they increase their productivity and also to reduce the cost of capital overhead? What is their vision? What's the vision of the company? You should know all of this information to know their trajectory, where they are heading towards. You should also know the historic performance of the company. You should know how they've performed 5 years ago. You should know how they performed 10 years ago. So down the lane, you can make clear judgments on how the company will look 10 years ahead, having looked at it from 10 years ago. So looking at all this qualitative analysis, that will give you a guide as to whether this company is worth your investment or not. So the second category, we'll look at the quantitative analysis. As you know, quantitative deals with amount, figures. So number one, we look at the earnings per share. So the earning per share is simply the company's profit per share of stocks. So if the company stock is selling at a particular amount, you should know the profit that is accrued to that stock and the initial cost price of the stock. Number two, we look at the free cash flow. So this is the leftover after all expenses are made. It is like a reserve of fund which could be deployed strategically for the overall performance of the company. So a company that has a strong foundation should have free cash flow. That is the reserve that is kept aside in terms of any turbulence in the company's operation. So instead of running helter-skelter or feeling discomforted, a company with a free cash flow can always have where to, dip its hand and make sure that they balance things up. So the third point that we'll look at in quantitative analysis is return on equity. This says how the company used the funds invested by shareholders to get more earnings. So if a company goes public, it is inviting external bodies, it is inviting individuals and maybe companies to invest in their companies. So if a lot of people are investing in that company, they can use the additional funds for expansion and to create a broader activities or operations for the company. So we look at the fourth point, which is operating margins. So this shows how much profit they make on a unit of each sales. The operating margins comfortably shows how much profit the company makes on units of sales. So when they sell a product, the operating margin shows the amount of profit in just one unit of that product. Number five, we have the PE ratio, the price earning ratios. So the price earning ratios is one of the most important stock valuation. So on all of this quantitative analysis, the PE ratio speaks loudly amongst all of them. So you should know the price earning ratio of a particular stock that you are eyeing to invest in. So the P/E ratio shows the valuation of a stock at a particular period of time, whether the stock is undervalued, whether it is overvalued, or is fairly valued. So that gives you hindsight at a particular point of time whether to go in or to wait when the valuation is fair enough. A low price earning ratio shows that the stock is undervalued. So if you know that the stock is undervalued, after doing your due diligence on other aspects of your analysis, I think that would be a very good time to pounce on that stock. If the stock is undervalued and the operation is up there and they have a good moat and they are innovating and they are doing very good in other aspects of their corporations, I think that's a good time for you to go into that particular stock. So the P/E ratio is calculated by a simple formula, which is price per share divided by earnings per share. So you should know the price per share and you know the earnings per share. When you divide it, you get your price earning ratio. So I want to trust that you've gained valuable information from this video today, and I want to admonish you to kindly hit that like button, subscribe to the channel, share this video amongst your peers and amongst your co-workers. Thank you, and I'll see you on the next video.